Hello, everyone. I hope everyone had a great holiday and celebrated Thanksgiving with family, friends, or just had a great 4-day weekend. We hope that those who have attended the last 3 sessions have learned more about your business financing. I'm Olivia Rios, Director of Operations and Programs at the LA Latino Chamber of Commerce, and I'm excited to be here with you today. Today's topic is cash flow management, and this will conclude the 4-part series for business financing brought to you by our friends at Bank of America. If you missed any of our webinars, they're available on demand. Part 1 was building business credit. Part 2, how to obtain loans in today's environment. Part 3, financing options for small businesses. Our banking expert, Valerie Rivas, will share with you how to manage your cash flow, set your budget, and look ahead to any economic changes. At this point, I'd like to welcome Valerie Rivas, Vice President, Small Business Community Officer at Bank of America. So Valerie, thank you for your continued support and for the help for helping the chamber members and small businesses. Our relationship with you and your team at Bank of America are very special. So thank you and welcome. The floor is yours.
Thank you, Olivia, and thank you to my partners over the LA Latino Chamber of Commerce. And welcome, everybody. Thank you so much for joining us today. And I also hope that everybody enjoyed the 4-day weekend or time with your families for Thanksgiving. I'm excited to be here today, and especially because this is probably one of my favorite topics, right? Just because we should be in the business of making money, right? So today we're going to be going through cash flow management and take a look at your budget to see how we can have that positive bottom line when it comes to cash flow. Now, wanted to introduce myself again. I'm Valerie Rivas, Vice President for Small Business Community at Bank of America. I've been in the industry for the last 19 years, been serving small businesses and entrepreneurs like yourself for the last 13. And I've been with Bank of America for a total of 9 years and done a lot of different roles throughout my career, specifically to small businesses. A little bit more about my education. I started going to Cal Poly Pomona here in the state of California, and I ended up graduating from University of Phoenix with a bachelor's in business management and a human resources certification. So I thank you all for being here. And I'm gonna go ahead and share my screen. Now, like I mentioned, today is one of my favorite ones. We're gonna get into a little bit of budgeting, a little bit about your profit and loss, how to take a look and see how we can manage your budget so that you can have that positive number at the end of the day for your bottom line. And why today is so important, and I always like to emphasize, are small businesses throughout the country that we survey every year. So we have a small business owners report. And one of the concerns in 2023 was inflation. And I'm pretty sure a lot of you who have owned a business already are probably feeling that way as well. So because of that, 88% of our small business owners are having this concern. It's really, really a good idea for us to take a look at your budget and see how we could adjust it for depending on how the economy is going and different things that you can do to be able to adjust your budget so that you can have that positive cash flow at the end of the day. As I mentioned before, I'm pretty sure we're all in business to make money. So today is going to show you some things and some techniques that you can use on your daily finances or depending on how often you take a look at your finances so that you can have that positive cash flow at the end of the day. So our agenda and what I'm going to be covering today is going to be what is cash flow, positive and negative cash flow budget, profit and loss statement, balance sheet, how to improve your cash flow, and we're going to finish off with a recap and see if you have any questions. Now, when it comes to cash flow management, a lot of the business owners are often focusing on what's happening in today's current environment. And because of that, it's, as a business owner or entrepreneur, it's very important for you to start planning ahead. And when I mean planning ahead meaning the next 12 months, maybe the next 6 months, but preferably just for you to plan ahead on what your forecast is. So maintaining a healthy cash flow will ensure for you to have that cash available when you do need it. And also it'll help you find out when you also need to obtain loans. So there could be times where maybe you're growing at a rapid pace, and you may need to hire employees, or you may want to take a look at your profit and loss and see what it is that you need to adjust. So how do we do that? We're going to go ahead and get into it right now. So we're going to start with, what is cash flow? So cash flow is managing cash flow, right? So how much money is going out versus how much money is coming in. So we want to know your revenue and what your expenses are. That is going to give us what your cash flow is. Cash conversion cycle is the amount of time it takes to convert investments and inventory into cash from sales. And this could also vary between different industries. So very, very important that when you're getting into an industry, you take that into account. And understanding your industry is very, very important for cash flow. So for example, right, the way that your cash conversion cycle could be, if you have a restaurant, could be different if you have a construction company, manufacturing company, or distributing company versus a retail, right? When you go to the mall and you purchase an item, you come in, you get an item, and you leave with the item paying right when you get there, right? So typically for retail companies, you come in, you pay for the service, or you pay for the item that you're purchasing, you leave with your shopping bag, and that's it. The inventory goes in and out, and pretty much that company makes the money right away. Cash flow forecast. So this is an estimation of the cash flow that is given in a future period. Typically, we talked about 12 months ahead. It could also be 6 months ahead, depending on your comfort level. But typically, 12 months is what we forecast. And when we talk about cash flow forecast, there's some things that you may need to consider. So some things that I can think of right now that you may need to consider is your seasonalities. So there might be certain industries that might be busier at certain seasons than others. So I'll give you an example. Right now, we are in the holiday season. So right now, maybe distributors for toys, kids' toys, and maybe games and things like that could be a really, really busy time. So you want to adjust your budget and your cash flow forecast based on your seasonality. Also, I've talked about it in my previous workshops. My dad had an HVAC business. So they fix air conditioners and also heaters. And so during the winter, he might be really, really busy, more busy so during the summer because people want to fix their air conditioners or install their air conditioners. Springtime, not so much because the weather is pretty manageable. So that would be things that you would have to consider based on certain industries. Now, according to an Intuit study of 3,500 companies with 0 to 100 employees, about 60% of the small businesses say they regularly struggle with cash flow issues, and 40% of them say that it has restricted their business growth. Now, everybody has different goals depending on your comfort level and the direction that you want to go with your company. Now, if business growth is something that you would like to do, it's something else that you may also want to consider, which is access to capital options, which we went through different financing options in our last workshop. Now, we're going to go through this cash flow cycle right here. Okay, so here we have, this could be inventory or it could also be a service. Inventory meaning that you can have a retail company, right? So you can maybe have a shop at the mall, maybe it's a perfume store, and you buy your inventory. So you have to take that in consideration and how long that's going to take you for you to make that money back. So with that being said, you have to consider in your bank account, there has to be that number where you feel comfortable having. And depending on your revenue, we talked about in the past, typically we want to see about 5% in your business account, and that'll kind of give us an idea of the health of the business and the health of the cash flow. So talking about inventory, you have inventory and the services, you have to see what your overhead is. So here we're talking about inventory and the services. Then we're going to go into collecting your funds. Collecting your funds for that service or the inventory that you are providing as a service or as an item that you are selling. Now, I talked about different industries can be different. It could depend on when you get that money back, right? So when you go to the mall, you purchase a perfume, you pay for it either with your credit card or cash, Zelle, Venmo, whatever it is. And then as a company, you receive that money right away. Now, things to consider is you may have a construction company, you may have a manufacturing company, you might have be a bookkeeping company. And in that case, you might not get paid right away. So you may want to consider that as well. So it could be 30 days, net 30, 15 days, depending on the terms that you give your clients. And it could also be that you have a retail company so that that you would be getting paid right away. Now, you have to take in consideration how long it takes for you to get paid after you provide that service or you give that inventory out. Now, what happens after, right? You receive the money, now you have money to go ahead and pay others that you owe. Either one, get more inventory, pay your employees, your operating expenses, any office supplies. These would be your accounts payable. Something that I recommend my clients to do is for all their operating expenses to leverage a credit card. Why is that? When you swipe your credit card, you have some time with a grace period of you paying that bank back or the lender back, right? So let's just say I swipe my card today, I can maybe have 15 to 30 days or even sometimes 45 days, depending on when you swipe your card, to be able to pay that bank back. And what does that do? It allows you to delay your payables. So you don't have to pay right away. So now what you're doing is you're leveraging a credit card to one, not pay any interest, but also delay your payables. So let's just say that you have a vendor that you have to pay and they give you a vendor's credit because maybe you pay them early. So if you pay them early, you pay them, maybe you get a 10% discount. And then now you are delaying your payables for anywhere from 15 to 30 days. So giving you a little bit more time to play with your money. So then what happens again? You do it all over again. And there's things that you can do to help your operating cycle and your cash flow cycle by maybe offering discounts for paying you on time. So it could be that you don't have a retail company, but you have a service and you have some payment terms. You can offer maybe a vendor's credit or a discount, maybe 10% discount, depending on the industry that you're in, so that you can get paid faster. A little bit later, we'll talk about different ways that you can get paid so that you can get paid faster and also increase your cash flow. Positive and negative cash flow, like I mentioned before, as a business owner, at the end of the day, we always want you to have a positive cash flow. So we want to have that positive number. We don't want to have a number that's in red. So what's positive cash flow? This is in which your business takes in money more than it spends. So it will put you in a strong position to invest in growth. If cash flow from operating activities exceeds expenses, you may wish to reinvest it in activities that can help you with the business growth, such as marketing. In healthy businesses, cash flow improves over time and in turn allows the overall business to expand. So what could be something that would be a good meeting to have as an initial meeting with a business that I am not familiar with? I would say have your profit and loss statement. Now, if you have Quicken, QuickBooks, or some sort of accounting software, and you keep it up to date, it gives you the health of your business. And you can run a P&L, or what we call a profit and loss or income statement. And on there, it'll tell you how the health of the business is doing. So it'll tell you whether one, you have a positive cash flow, or two, you have a negative cash flow. There's been times when I've met with a client and I take a look at all their operating expenses, and really on there, everything looks fine. It's just maybe you might just need a little bit more help in increasing your sales. So that's when you have to reevaluate if one, you don't have enough manpower, excuse me, to be able to handle your sales, or two, maybe you have to invest a little bit of money in marketing, or it could be maybe you have to hire a new employee or take a look at reducing costs. Sometimes it's really just about bringing in more sales. So you need to evaluate of how you need to do that. Whether one, it's take a look at your inventory, or it could be inflation could be affecting you, right? So cost of goods sold. So the cost of goods have maybe gone up, and therefore maybe you have to reevaluate who your vendor is or who your supplier is, and see if maybe you can get the same type of product, maybe at a lower cost. So those are some things that you need to take a look at when looking at a P&L or a profit and loss. We'll take a look at one briefly just in a short time. So if you are experiencing negative cash flow in which your business spends more money than it earns, that's not the goal, right? But sometimes you may experience that, and maybe in the first couple of years, because you may have more expenses for the startup costs. So you may want to consider a startup loan to help you with that. So that way you don't necessarily have to struggle so much with the negative cash flow. But there's certain things that you can do, like I mentioned, a credit card as well. So you'll most likely need to optimize operating costs, revenue collection practices, reducing the expenses is one of the quickest ways. So very, very quickly, sometimes I take a look, and it could be maybe you have really high merchant services fees, right? So you have to take a look and see who you have your services with and how fast you're getting that money in. It could really just depend on, maybe you have a client that slow pays, and maybe they're holding a large amount of your account receivable, which is also a question that lenders will ask you of, is there any client that holds most of your revenue coming in? Because that could also affect your cash flow. So the lower you're spending on labor, office space, production, supplies, and other common expenses, the more cash you will have on hand. Improving billing and collection practices can also keep cash flow into your business. So we talked about collecting your payments faster. So ways that you can do that, and we'll get into that also shortly. So here is a cash flow budget, or we also could call it a statement. And this shows you how much money comes in and how much money comes out of the business. So this would be something that I can maybe ask my client, let me see your cash flow budget and see maybe if we can make any type of adjustments. So on here, we see it's a little tiny, but on there it says on top that they are getting in $693,000 in revenue. And then it shows some of the expenses. So there, you take a look at inventory purchases, general operating administrative expenses, wage expenses, which is to pay your employees, any interest or income taxes. So just in the operating activities, we're taking a look, and their bottom line is a positive cash flow of $148,250. We're taking a look at investing activities, which is the second section here. And on here, it looks like they might have sold a property or equipment. So there they got positive of $33,600. But then we take a look, and they also purchased equipment or a property or a fixed asset. So they spent $75,000. So in this section, they're at negative $41,400. So when we calculate all of this, it's really all just basic math of getting your revenue minus all your expenses. And here we're taking a look at financing activities. So issuance of stock, so they got $65,000, they're borrowing $15,000. Repurchase of stock, meaning that they spent money, right? So money went out. So when you go and you subtract and add everything out, At the end, they have 43,000 of positive cash flow. So that is what this particular cash flow statement is saying here. Report such as your operating budget, track overhead, labor, and production costs. So there may be times, unfortunately, that you may have to cut back hours in order to stay afloat. Or you may need to take a look at what your current environment. So for example, the pandemic, right? You might have to adjust how much staff is working at a certain shift. Unfortunately, maybe that employee may need to go look for another job while, you know, the pandemic, or while you can give them more hours. And then we have burn rate. So a company's burn rate is the pace of which they are spending money before reaching positive cash flow. So this could be that you are pretty much burning your money before you are reaching that positive number at the end. And this could also be affecting, because it could be you're not collecting as fast. So having the right tools that can help you with cash flow budget and keep it updated regularly. So with these accounting softwares, they actually have an option of where it'll help you create a budget. So on there, you can take a look and what adjustments you need to make. And like I mentioned, there's certain things that are foreseen sometimes that happen. So you may want to take a look at that sooner than later. So typically, you know, we want to take a look at on a quarterly basis. Usually the budget is set for the whole year or 6 months, depending on your comfort level. But if there's any changes in the economy, or maybe your cost of goods sold went up, those might be things that you want to consider revisiting your cash flow budget to see where there might be any adjustments that you need to make. So here are 7 steps for creating a cash flow budget. Is 1, find the right tool. So we talked about having an accounting software to help you do that. Sometimes I'm really old school sometimes when it comes, and I want to see it in paper, so I'll write it down before I put it into an accounting software. So whatever makes you feel comfortable, but at the end of the day, you just need to find what the right tool for you is. It could also be an application that maybe you have on your phone. It could be something as simple as that, or it could be something that you have that you do manually. But for the most part, the most ideal nowadays would be an accounting software. It helps you do budgets, and it also helps you run your profit and loss to take a look at the health of the business. Set a time frame. So we talked about typically clients will do anywhere from 6 months to a year. Take a look at that year's budget. So try, you know, right now we're getting ready for 2024. So you want to start thinking about what your budget's going to look like for 2024, whether it's within the next 6 months or for the full 12 months of next year. Prepare a sales forecast. So there's going to be some businesses that you might be steady throughout the year, but then there might be some businesses and industries where you encounter seasonalities. And when I say seasonalities is maybe you are busier certain months than other months. So you also want to take that in consideration when you're creating your budget of what your forecast is for those months. That might be a little bit busier, or also have a shortfall. So that way you can take a look at what you might need. You may want to also consider a line of credit, or you might want to consider a working capital loan to be able to cover those gaps when your cash flow is affected. Project cash inflows. So this is your cash in, that includes all forecasted sales and revenue, and both cash sales and those for customers who pay on credit. So you gotta take in consideration how much money you're getting right away and how much money you are waiting to get paid. So there might be that you have multiple clients that are slow paying, meaning that they're not paying on time. So you may want to follow up with them, see if you could get a better collections on how to collect your funds faster, or see what other ways of payments that you may be able to offer and where they can get incentive of then paying you faster instead of having to wait 30, 60 days, depending on who what your contract says with your client. Project cash outflow. So this is the cash going out. So earlier I talked about delaying your payables, right? That's the money that goes out. So while you're waiting to get paid anywhere from 30 to 45 days, depending on how much time you need to buy, you may want to consider putting these operating expenses on your credit card. And when you get that credit card statement, just pay it right back, so that way you also don't have to pay any interest or get in trouble with carrying those balances. Calculate the ending cash balance. So create a formula to add all your cash inflows for each month. The difference will show your monthly cash, which is on cash on hand. So I talked about earlier how you may have that number in mind of, hey, when my bank account hits $20,000 or it hits $5,000, whatever that number is, you want to take in consideration of what are some things that you can do to improve that. So you may want to take a look at your budget. Maybe you have an American Express that you're paying $1,000 a year. That may be something that you want to consider, and maybe changing the type of credit card, maybe to a credit card that doesn't have an annual fee. So little things like that can help you. Also, it could be that maybe on a monthly basis, you offer lunch for your employees. And although it's very important to keep your employees happy, maybe that would be something that you may want to consider also maybe not doing. So little things like that can help out as well on cutting your expenses. Set a minimum cash flow balance. So determine how much cash you will need to have on hand every month. So like I mentioned, having that number of what's comfortable for you. I have some clients coming in and say, Valerie, you know what, I don't know what's going on. I'm having a little bit of trouble on the receivables. Maybe they're doing business with an industry that's struggling a little bit right now because it could be slow season and they're not getting their receivables as fast. So therefore, they can do their payables as fast to my client. So that's something else that you want to consider, is what industries you're doing business with as well. And just be aware of the businesses that you're doing business with, because you also have to take that in consideration on your cash flow cycle. So profit and loss statement. I talked about this earlier. This is also known as a P&L for short. And this is actually very, very basic math. So if you really just take your sales minus the cost of doing business, that will equal your profit. So right here, we take a look at the top here. You're taking a look at the income. We're taking about 31,641, and it looks like they're also doing hardware, so they're getting income there of 21,404. So their total income is 53,045. We take a look at some of the operating expenses, which would also include wages to their employees. They're paying about $15,000, and it says material cost is costing them about $11,000. So right there, the cost of goods sold is $26,000. So their gross profit is $27,045. So really all we're doing here is getting the total income, subtracting it by 26,000, and it gives us this number right here. These are the costs of goods sold. Now we're taking a look at other expenses. So we're taking a look at how much money it takes for them to do advertising or any type of promotions, any insurance expenses, other expenses that they might have, postage, rent. Rent is actually a big one that I've seen on their profit and losses, where maybe they have a warehouse that they're paying for maybe $30,000, let's just say, and you may want to consider, hey, what is it going to cost me if I go ahead and buy a commercial property? So I've had clients that go from paying, excuse me, that go from paying maybe $30,000 to maybe now $15,000 by owning their own property. Not that that's going to be the case every time, but that's also something that you need to consider as well. In this case, they are actually at a negative cash flow. So if you take a look at the bottom, they're actually negative 11,016. So profit and loss statement is also known as the income statement. And it summarizes the revenue and expenses, and it provides insight on how much money your company makes and loses over a period of time. So it gives you a bird eye of your financial picture of the business and pretty much where you stand. So like I mentioned, if you have an accounting software, very, very important that you keep it up to date, because it'll let you know if you're doing positively on your business or you have a negative cash flow. The typical P&L statement will include following categories. So it'll be the net sales, which is your revenue, how much money is coming in, cost of goods sold. So we talked about the wages and what it's costing you for you to do business. And then selling, general, and administrative expenses, which are your operating expenses. It could be your office supplies. It could also be insurance payments, your rent payment. So pretty much your overhead, and then your net income. That and the profit calculated. So we take a look at your sales minus your cost of goods sold equals your gross profit. This is your overall revenue. After that, your P&L will subtract other costs. So gross profit minus other expenses will equal your net profit. So at the end of the day, we want to see a positive number when it comes to this. So this is how much money your business is actually making. Like I mentioned, we want to see a positive number on there because we're in the business of making money. So if it's at a negative number, we really need to take a look at your budget and see what there might be some adjustments. This could include maybe lowering wages. It could also include maybe take a look at your workers' comp. I've seen workers' comp be a huge amount of money that they're paying on a yearly basis, and we've been able to save them maybe $12,000, which can make a significance to your bottom line. There could be other things also. I had a client that said, Valerie, if I go ahead and add a water truck, I think he was going to add $150,000 in a net profit. So he was actually going to make an additional $150,000 a year because he was no longer going to be leasing it. So those are also other things that you may also want to consider. So your P&L tells you exactly what is working and what isn't. It also explains in a few short lines which efforts can safely be doubled down and which need to be refined. So very important you take a look at your P&L. You take a look at what adjustments you can make. Into a balance sheet. So a balance sheet is a snapshot of how financially healthy your business is. It could tell you whether you're prepared to jump on new opportunities or even how attractive your company might be to potential buyers or investors. So some of the things that you'll see on a balance sheet are going to be assets, liabilities, and shareholders' equity. When you look at these data together, they give you a quick glimpse of your business financial status. A balance sheet is based on simple formula. So this is assets equals liabilities plus shareholders' equity. Now, some of the things that you may not think about, but there's things that you can actually do to make your balance sheet stronger. So this could also be maybe adding a commercial property. Maybe you're already at that stage where you're able to buy your own commercial property where you can move in your business, and this will be now an asset to the company. Something else that you might also want to consider is you might have your vehicle that you use for business and you have it under your personal name. So if you're to also add or refinance this vehicle under the business or your LLC or corporation, now this also becomes an asset to your company. So this will make your business more attractive. It'll add assets to the business and pretty much just make your business stronger, especially if you are looking to sell your company. This is, or if you're looking to sell your company, or maybe you want to partner up with somebody where they want to buy in, they will ask for your balance sheet because they want to see how strong your company is. And so just kind of giving you a couple ideas, those are just some benefits where you can add value to your company of also maybe even financing, because when you're financing a piece of equipment, you also get the benefit of potentially getting depreciation, which can also be an asset to the company. So those are just a couple of things to think about. And here it says a balance sheet is something you should create early in the life of your business and maintain on an ongoing basis. Most business owners look at their balance sheet on a monthly, quarterly, or yearly basis. So it gives you the overall snapshot of how healthy when it comes to the finances your business is when you take a look at the balance sheet. Now we're going to take a look at the balance sheet key components. So assets, liability, and shareholders' equity. So here at top is assets. So what is assets? This is going to be everything that your business owns. And it could also be called goodwill, which includes intangibles like your reputation from years of building a relationship with customers, or the value of your logo or brand. So on here, you take a look at their total assets. It's $22,334. We're taking a look at liabilities and equity here. So we take a look at here, and the total equity is going to be $12,984. So if you take a look here, total assets matches the total liabilities and equity. So liabilities is pretty much everything that your business owns. So this could also be money owed to your vendors. And remember our first class, we talked about also asking your vendors if there's some sort of penalty for you not paying on time, because this could also affect your credit. So just going back onto our first workshop. So these are also obligations of what you might owe on your credit card. So if you're carrying those balances, any accounts payable that you may have, it could also be wages, or it could be overdue payment. So here would be the liabilities, and then shareholders' equity. So this means anything that would be left over after all the company liabilities are satisfied. So in small business, the owner is often the sole shareholder for most of the time. We talked about one pocket to another, right? In my other workshop. So on here, it pretty much gives you a pretty quick snapshot of how much total assets you have and the total liabilities and equity you have. So these two right here should always balance. Now, how to improve cash flow? So improve inventory management. So keeping a good record of inventory, not having too much inventory at one time. This could also improve your cash flow. But there also might be other times where maybe you get a discount for having a little bit more inventory because maybe they have some sort of sale or something like that. So that might be also that you want to consider as well. I also want to mention that there is some softwares out there that will also help you manage your inventory. I don't know if you've heard of Clover. So if you have a restaurant or you have a bar, let's just say, you can input on there and it'll tell you pretty much based on how you're using it, when you can actually replenish your inventory. So something else to consider as well, depending on what industry you're in. I mentioned avoid ordering more inventory than what you actually need. Select receivables promptly. So I mentioned you may want to consider what type of terms you have with your clients and what kind of clients you also have. And when I say what kind of clients, is consider also their industry. So it could also be that you might be doing government contracts. So government contracts may take a little bit slower pay than if you were just dealing with a private company. So establish a net 30. Some of my clients have a net 15. So just really depending on what your comfort level is and the terms that you do with your clients, it all really depends on the type of contracts that you have with your clients. So other things that you may want to consider are getting paid faster, because we want to make that conversion, the cash conversion rate pretty quickly, meaning that you collect your accounts receivables faster. So something else that you want to consider is accept credit cards. Also mobile payments or electronic payments, such as ACH or EFT. Those could be other ways that you could actually get paid faster. You also want to consider, if you do accept credit cards, how fast that lender or that bank actually takes to get to that money. So I know that certain merchant providers, they could provide as soon as the same day, where you get paid a lot faster. So you want to consider that. There also might be some merchant providers, when you accept credit cards, that maybe could take, because it's too much of a large amount, they might take 7 days to pay. Or I don't know if anybody's ever experienced this, where it might take 2 weeks to pay because maybe it's a transaction that is a little bit larger than usual. So manage cash wisely. So when picking a merchant service provider, kind of just got ahead of myself, it allows quick access to your funds from credit card payments. So make sure you have enough cash on hand for the next 90 days. So also, consider how fast they're actually paying you back when it comes to when your clients are sliding that credit card. Optimize accounts payable. So analyze your spending habits, revisiting and reviewing your costs regularly. So we talked about what your expenses are and where you can adjust them. I talked about maybe something as little as annual fees that could actually all add up. You could have multiple, maybe credit cards that have an annual fee and you haven't realized it. Or there has been times where a client has a line of credit, and each year that it renews, it could cost them thousands of dollars, depending on the terms that you have with that lender. Little things like that are really good to consider that can actually add to your bottom line. Choose vendors that are flexible on payment terms and prioritize invoices according to due dates. So very important, because we've got to take a look at your business credit and take care of it. Also, make sure that you're prioritizing those that actually have due dates, and also choose those vendors that have flexible on payments. So we talked about on building business credit, that sometimes we may not consider that maybe our vendor or supplier actually reports us to the credit bureau. So that's something that you also want to have knowledge on if that's happening or not. Prioritize credit card bills both by due dates and interest rates. Pay the cards with the highest interest rates first, then work your way down. Now, ideally, as a banker, I would recommend for you not to leverage over leverage your credit card. So what I'm trying to say is use it so that you can improve your cash flow cycle, but also try not to carry the balances. Although sometimes, when it comes to seasonality, or it might be a little slow that month, or maybe you didn't get enough sales that month and you didn't collect as fast, you may want to consider actually carrying the balance. But for the most part, what you want to do is just leverage it so that you can help manage your cash flow cycle and help delay those payables. Reconcile daily so you know where you stand when prioritizing payments. So that way you can categorize where your money is going, and when looking at your P&L and when you're looking at your profit and loss, you can take a look at where your money is going and where maybe you need to make your adjustments. If you're not reconciling daily, it could get a little bit more difficult, just because you might be making more payment. You might have something more in one category than another, and you won't know if you're not reconciling it on a daily basis. Again, your accounting software program can help you actually manage that as well. Now, determining the overall health of your business. So we're going to go ahead and recap. So we talked about budgets, right? We talked about taking a look at your budget. We typically want to do that anywhere from 6 months to 12 months ahead of time. Always review your profit and loss. At the very, very minimum, try to do that on a quarterly basis, just so that way you know where you stand. And also, you got to consider, when it comes to your business, every 3 months your revenue can also change. So that's something also you want to consider. And just make sure that you're being proactive and look ahead and take a look at any changes that you may foresee. Also be very, very aware of where our economy is also going. What are some of the concerns out there? And keep yourself updated on the industry, so you kind of have an idea of what to expect in the maybe 3 to 6 months, and you can adjust your budget accordingly. Now, on here, I have 3 different QR codes So the first one, if you want to go ahead and scan it, it's small business resources. I did talk about this a little bit further last week. And what we talked about is we have our $25,000 down payment grant that's available for our women-owned and multicultural-owned businesses. We also have different cohorts that are available, grants that might be available. We have our Access to Capital directory, which I went through last week, which will give you different resources with our nonprofit partners and also different resources that are available. So that would be our first QR code. Our second one is Better Money Habits. So if you are interested in knowing more about financial literacy, how to improve your financial health, whether it's on the personal side, maybe you want to start preparing for college or your kids' college, maybe that's something that you want to help pay for, we can help you prepare for things like that. Also, if you're taking a look at getting a home loan, we have webinars on there as well that are available. So go ahead and click on the second one. And then the third QR code is if you want to learn more about Bank of America and also more webinars that are available, like the one that we did today. I apologize for my coughing today. I don't know what happened. But I do want to thank you for joining, and also thank yourself for joining today and learning more on how to improve your business and investing in yourself. And yeah, Olivia, thank you so much for having me today. Thank you to the LA Latino Chamber for having me and for your amazing partnership. I don't know if anybody has any questions.
Yeah, so I'm reviewing the chat, and we have one from Patricia. Is there a free accounting software that you know of that you can recommend?
I can't think of any actual software. What I can tell you is that we do have a 30% off that might, and it's not free, but it's definitely a discount for the first 12 months with QuickBooks. Let me see if I can pull it up, and then, or actually I can email you the toolkit so that you have it.
So I have a question from Basam. What are the correct percentages to collecting from our monthly sales?
I think that really does vary with industry, I would say. Just because if you're in a retail company, you have a retail company, I mean, you should be collecting pretty much a large portion, right? 100%, if anything. But if you have a manufacturing company, and it just really depends. I can't really answer that question because it just really depends on who your clients are. So like I mentioned before, you could have clients that can slow pay you, and their government contracts, government is going to pay you. It could be, I've seen 6 months, 12 months, depending on what part of the sector of the government is paying. So it's really hard to say. But what I can tell you is if you have 5% of your revenue in your business account, that kind of gives you a pretty healthy cash flow overall. This industry, rule of thumb. I hope that helps.
Okay. We have Carla who asked, what should be our payroll percentage in a commercial cleaning business?
I don't have the exact number because I'm not an industry expert in that particular industry. However, what I can tell you is we do have data that'll tell you based on your industry what the industry average is. So if you'd like to set up an appointment with me, I'd be happy to go through those numbers. I actually have access to that data where I can access for you, and I can take a look at what your industry average is, and I can tell you what other companies in your particular industry is doing. And not just payroll, but other things as well, like their operating expenses, how much they're spending in inventory. It'll give me a percentage overall through the industry.
Right. Can you quickly put in contact information in the chat box so that people could access or connect with you?
Yes, of course.
We have
Let
Tim
me go ahead
Marquez
and
who
do
says,
that.
I would like a meeting too. So so that would be really great to connect with our members. I just entered your email because it's pretty easy.
Perfect.
First name, last name. at bofa.com.
Yes, definitely. If anybody's interested in knowing more about your specific industry, I can definitely pull that data. I don't know it off the top of my head, but I'll be happy to look it up for you.
Okay, and then you can also share, maybe for the ladies who called about the grant for women. First of all, I want to thank Valerie and her team for being gracious to hosting this first time 4-part series. You know, we know it's really important to get your business in top financial shape. And with the webinars that we hosted recently, I'm sure that there's boxes that you have probably have already checked off. So we're really glad for that. So with that, I'd like to thank everyone for being with us today. Have a blessed weekend. You know, we're in the spirit of Thanksgiving, and I know today is Giving Tuesday. We haven't promoted anything yet, but if you do have an organization that's dear to your heart, please consider giving. You know, a lot of the organizations that need our help are those that help children. I'm very proactive on education because education does get you out of poverty and makes you become entrepreneurs so that you can grow, be economically well, and create wealth for your future generations. So I'd like to leave on that note. Please give to your favorite organization. I can't name any, but I know you know many that are within your own community. So thank you again. Have a blessed week, and we will see you hopefully tomorrow. Alrighty, thanks everyone for being with us. Bye-bye.